Hey everyone, and welcome back to the channel. Today we're diving deep into the world of a true tech titan, Meituan. If you ever ordered food, booked a hotel, or even rented a bike in China, chances are you've used their services. They're a massive force in the on-demand economy, but their recent performance has been a bit of a roller coaster. So the big questions on everyone's mind are, what's really driving Meituan's growth? What are the hidden risks? And perhaps most importantly for investors, should you be considering this stock? Or is it better to just hold on for now? Let's break it down. If you haven't already subscribed to our channel, please subscribe to our channel. Your support truly makes a difference, enabling us to produce more stock and fundamental analysis content. But first, a quick disclaimer. Please note that the content presented in this video is for informational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. Let's understand who Meituan is. They're not just a food delivery company, they're essentially China's super app for on-demand services. Think of it like having Uber, DoorDash, Expedia, and even a bike-sharing service all rolled into one seamless platform. They dominate the food delivery market in China, holding nearly 70% of the share. That's a huge piece of the pie. But this market isn't a quiet one. It's often called the Three Kingdoms rivalry, with Meituan battling it out against giants like Alibaba's L.me and JD.com. This isn't just about who offers the cheapest meal. It's a fierce fight for restaurants to partner with them and for delivery riders to join their fleet. JD.com, for example, has been aggressively offering zero commissions to new restaurants and even full social insurance for riders, directly challenging Meituan's established network. Meituan CEO Wang Xing has even famously said he's willing to spend 10 billion renminbi here, 10 billion renminbi there to defend their market leadership. This tells you just how intense this battle is. Now let's talk money. Meituan's first quarter of 2025 showed some impressive numbers. Their total revenue jumped by over 18% year-on-year to 86.6 billion renminbi, and their adjusted net profit soared by a whopping 46% to 10.9 billion renminbi. This beat expectations largely thanks to better margins and more efficient operations. Their core business, which includes food delivery and their instant shopping service, Meituan Insta Shopping, performed strongly. Interestingly, while order volumes grew, the average value of each order actually saw a slight decline. This isn't necessarily bad. It shows Meituan is strategically focusing on offering value-for-money products to attract cost-conscious Chinese consumers. However, here's where it gets tricky. Their new business segment, which includes their ambitious overseas ventures, is still losing money. And looking ahead to the second quarter of 2025, analysts are actually forecasting a decline in adjusted net profit and operating margins. Why the sudden shift? It's a direct result of those increased subsidies to fight off competition and the widening losses from their global expansion. It's a strategic choice to invest heavily now for future gains. Despite the short-term profit squeeze, Meituan has some powerful engines driving its long-term growth. First, their core local commerce business remains incredibly strong. Food delivery continues to attract new, younger users who are highly engaged. And Meituan Insta Shopping, their non-food delivery service, is booming, with non-food categories growing over 60% in Q1 2025 and attracting over 500 million users, 2/3 of whom are young consumers. Second, technology and innovation are at the heart of their strategy. Meituan is heavily investing in AI and robotics. They're using AI to boost employee productivity and customer service by over 20%, developing AI assistants for restaurants and travel, and even building their own large language model called Longcat. They're pouring billions into securing powerful computing resources. This isn't just fancy tech, it's about making their operations more efficient, which can help offset rising costs in the long run. Third, global expansion is a huge play. Their Keter service, launched in Saudi Arabia, is showing strong growth and has expanded to over a dozen cities. The Middle East offers higher average order values and better profit margins compared to China. They've also announced a massive $1 billion investment to enter Brazil's food delivery market, where penetration is still relatively low, signaling huge untapped potential. This is a clear move to diversify beyond the intense competition at home. Finally, Meituan is strengthening its ecosystem and supporting its supply side. They're launching bright kitchen programs to improve food safety and, crucially, investing heavily in courier welfare. They've provided accident insurance for millions of riders and is starting to cover social benefits for their full-time riders, which is a significant commitment. These efforts are vital for retaining their massive delivery workforce and building a more resilient platform. Now, let's talk about the challenges. The most immediate risk is the intensifying competitive landscape and price wars in China. That Three Kingdoms rivalry is forcing Meituan to spend heavily on subsidies and rider benefits, directly impacting their profits. Goldman Sachs even warned of a profit shock, estimating Meituan's operating profit could decline by 25 billion renminbi in the next 12 months due to this price war. Then there's regulatory scrutiny. China's market regulator has drafted new guidelines urging platforms like Meituan to charge reasonable fees to merchants. While this aims to help small businesses, it could limit Meituan's pricing power and force them to adapt their business model, creating some uncertainty. As we mentioned, the short-term profitability pressure from these strategic investments and subsidies is real. We're expecting to see declining profits and margins in the current quarter. And finally, cash flow. While Meituan has a lot of cash, their free cash flow is actually projected to turn negative for 2025. This means they'll be burning cash to fund these aggressive growth and defense strategies, and they also have significant debt repayments coming up. Despite these headwinds, Meituan's financial standing remains quite strong. They have a robust balance sheet with significant cash reserves, over 180 billion renminbi in cash and short-term investments. This gives them a crucial buffer to weather the current storm and fund their ambitious plans. When it comes to analyst sentiment, it's largely positive. Most analysts have a strong buy rating on Meituan, with an average 12-month price target of around 175 Hong Kong dollars. However, it's important to note that many analysts have recently lowered their price targets, reflecting those reduced margin assumptions due to the higher subsidies. So while they believe in the long-term story, they acknowledge the short-term pain. So what's the takeaway? Meituan is a company with a powerful core business, ambitious global expansion plans, and a strong commitment to technological innovation. They're a market leader, deeply integrated into the daily lives of millions. However, they are currently in a phase of aggressive, costly investment to defend their market share and expand into new territories. This means we are seeing significant short-term profit pressures, intense competition, and some regulatory uncertainty. Given these dynamics, our recommendation for Meituan right now is a hold. Why hold? Because while the long-term potential is there, the immediate future is likely to be volatile, with profits under pressure and cash being consumed for growth. But when should you consider or buy? Keep an eye out for these signs. If the competitive landscape in China starts to stabilize, leading to more sustainable profit margins. If their new international businesses like Kita show clear signs of containing losses and moving towards profitability. Or if there's a significant dip in Meituan's stock price that offers a more attractive entry point reflecting its long-term value. Meituan is playing the long game, sacrificing immediate profits for future dominance. For investors, patience and careful monitoring will be key. Thanks for watching. If you found this analysis helpful, please hit that like button, subscribe, and let us know your thoughts on Meituan in the comments below. We'll see you in the next video.